Good morning, everyone. Welcome. Thank you for joining us. Great to have you with us here in the room, of course, online and watching on playback as well. Great to be here. Great to be back in Hong Kong, physically in the room together. It's a treat. We're really delighted with the turnout and interest in this event, especially it was only dreamt up in March after we jumped on the first plane from London to China that we could when the pandemic restrictions drew to a close. It really is a pleasure to watch the financial world spring back to what it does best, making connections worldwide, face-to-face to create new business. OMFIF's starting point, for those of you that don't know it, is the central banking community. And it's thanks to HKMA's support and encouragement that we're here today. So thank you, Eddie, Rami, and team. It was great to get your initial enthusiasm for us to put this event on. And we'll hear from Eddie in just a moment. Central banks, I think it's fair to say, have a lot on their plates at the moment, in many places, of course, fighting inflation, sometimes with negative real rates. So we'll see how that goes. When in OMFIF sessions during the early pandemic, we had lots of seasoned economists, as you'll probably remember, talking about the impossibility of inflation. And negative real rates have been taxing all investors and pushing them to experiment. Though OMFIF's recent survey of reserve managers is showing an unsurprising shift medium term back to government bonds, which post-QE, post-inflation, may actually provide a bit of return now. So this will, of course, drive changes through all asset classes and may suck money back out of those experiments. So let's see. My colleague Clive Horwood will talk all about that in a little while as well, when he takes you through our reserve managers survey later on this morning. And that also brings us back to Hong Kong, because we found gentle shifts, for example, for now in reserve currency intentions. And we'll take you through that. I think you'll find it interesting. The dollar is reigning supreme, slight decline. There are interesting trends that we found with reserve manager intentions with renminbi. Of course, Hong Kong has unparalleled access to mainland Chinese capital markets, but is pegged to the dollar all the while. And some people may see a dissonance there and wonder if Hong Kong can simultaneously live in these two ecosystems as potentially de-globalize. But I think that's wrong. I see a useful and important attribute as a pivot between these two ecosystems. So we'll come back to that throughout the day several times, I'm sure. Central banks and regulators are also working through a revolution in the format of money and assets. OMFIF spends a lot of time on this, not just the whys and wherefores of CBDCs, which become more complex the harder you look at them, but also the entire financial system. The most radical versions of DeFi a couple of years ago now really saw a world without commercial banks even, or central bank money for that matter. And they were almost certainly making a mistake. But they've set in train an inevitable digital evolution in finance. Again, Hong Kong sits in an interesting place here. It's part of Enbridge, a important wholesale CBDC project with the PBOC, but also many others around the world. But Hong Kong also has its own distinct digital assets regulation, which seems a little bit more flexible than elsewhere, but carefully so. And we'll explore that later as well today. I think it's important. The main reason we chose to run this event is that we felt the perception of Hong Kong's status as a financial centre had perhaps drifted away from some of these fundamental and important realities, perhaps as a result of its isolation during the pandemic. And we felt that those needed updating and reassessing. You'll have seen, some of you, the chatter, I think, in the financial press about Singapore challenging Hong Kong as a wealth management centre. We'll take a look at that in detail this afternoon with my colleague Lily Zhu. Hong Kong may have had its issues perhaps, but it seemed to me that some market observers were starting to forget its rather unique utility as a pivot between China and the rest of the world in capital markets. Of course, through its Connect platforms, but also, of course, its own securities market. So we want to explore that again today. I was struck on a trip through here in March and then on to Shenzhen, Beijing and Shanghai by the idea that if Hong Kong didn't exist, it would certainly need to be invented. And I noticed more support for the role of the city in finance than I had before 2020. Aside from all of that, I've got a personal attachment to an affection for Hong Kong, having spent a lifetime visiting financial centres. It has a certain unique magic, as I'm sure you'll agree, like many port cities that face the world, which I think is quite deeply rooted here, and long may that continue. So I hope you enjoy today's event. You'll learn plenty, I think, and make new connections. Hong Kong is, after all, as our speaker's dinner concluded last night, a super connector. So please enjoy the day. We're starting this morning with the CEO of HKMA, Eddie Yu. So Eddie, please come to the stage. Thank you for joining us, Eddie. It's great to have you with us.
It's a great pleasure to be here, and it's great that everybody is coming back to the city, as you said, sitting together in the room discussing Hong Kong and global issues.
And congratulations on HKMA's 30th anniversary.
Yes, it's been, time flies. It's been 30 years since we started actually in a very modest little office in the Admiralty Center with only 60 people in the Office of the Exchange Fund. And now we're more than 1,000.
Yeah, and doing, I think, a terrific job. We'll come back to that anniversary in a bit more detail in a moment. I want to start with the perhaps the most obvious question for a central banker is what you make of this global fight with inflation, both internationally and locally here in Hong Kong.
Well, in Hong Kong, it's not really that much of an issue. We've only got very moderate inflation in the last few years. Two reasons. One is that because of the pandemic, we opened up a little later than the others, and domestic demand has not been strong until we reopened. So the inflationary pressure from domestic demand came a little later. But more importantly, in the CPI basket of Hong Kong, a good part of that, about 25%, is made up of rent. And housing and rents, as you know, has been quite soft in Hong Kong. So we've been hovering around 2%. And this year with the reopening, we thought that it might be around 2.5%, but it's still not very strong. But globally, of course, inflation because of energy, because of supply chain, etc., it's been shooting up the roof. But now with central banks tightening at a very, very fast speed around the world, it's now coming back to like 4-5% in the US, and then also coming down in Europe. UK is a bit harder. But I would say that this last mile of getting from 4-5% to 2% could be challenging and could be a long one, because now we're not really talking about just energy. Energy and supply chains have gone back to more normal paths. We're talking more about service inflation. When you see wages being quite sticky and still going up, the labor market, surprisingly, despite the high interest rates and the slowing economy, the labor market remains very strong. So we'll see whether wage will come down gradually. That will lead to a lowering of inflation. In China, it's actually very soft. But I think it's transitory in China. Well, I should not use that word.
No, that word. The Bank of England said that, and they made a mistake, I think. But you're right. There's certainly a debate between economists about whether the work is already done through monetary tightening internationally. People pointing to our Astana, a long-run trend for demographic reasons to an even lower average interest rate over time, and those who say we've now got embedded core inflation and second round effects. Where might you sit in between those 2 points if you were to have a view?
Well, I think in the short medium term, the inflation, I think it will, as I said, it will take a long time maybe to get back to target, and I think it will be hard to say that, hey, whether our style is really trending down as much, or whether it's the various factors that we talk about, like demographics, like technology or globalization, that leads to a trending down of inflation in the medium longer run. Now we're seeing other structural inflationary pressure, like if supply chain becomes more fragmented in future, the green transition could be a slightly inflationary. and the structural changes in the labor market could be inflationary as well. So it's hard to tell, but what I would say is that it will take a while. Interest rate probably will stay higher for longer until we see wages really solidly coming down.
One of the concerns that has been raised recently about rising rates, of course, is financial stability. We've seen a couple of quite notable bank failures. What's your thinking on the financial stability risks of monetary policy? It's a very annoying problem for central banks globally, and of course, bringing that back to this region.
Right. When you see interest rates rising by more than 500 basis points in just 1 year, it's actually quite a big shock for anybody operating in the financial markets. And for that to have less impact on financial stability, what needs to be done is one, regulation, and second, supervision. It's really how you supervise individual markets and financial institutions that matter. If you look at what happened in the US, I thought the Fed report said very clearly that supervision can actually be tighter. But what's good is that despite what's been happening in US and Europe, the authorities have taken quite quick, decisive, big steps in containing what happened, what the cracks, so that there's no systemic issues coming out from there. So I think it's more or less now settled, but when interest rates remain at that level, probably longer and higher than what the market has been expecting through the futures market, then what we need to really look at is the impact on, for example, commercial real estate, the impact on non-bank financial institutions, which has been really expanding fast in the last few years. So I think there are several areas that we need to watch. Coming back to Asia and especially Hong Kong, the spillover from what happened in US and Europe was a lot smaller than I thought. I thought for several reasons. One is that the banking system around this region, especially in Hong Kong, is actually quite tightly regulated. The capital ratios of banks in Hong Kong average about 20%, liquidity coverage ratio about 160%. And we also sort of supervise them quite tightly. So you don't really see the how to maturity profile, the interest rate mismatch that you saw in some of the US banks. So we thought that it's really the buffers that we keep in the banking system, the tight supervision that we have of our financial institutions, and the relatively less developed non-bank financial institutions sector in Asia. That got us to be a little more sort of stable, but it still, with interest rate rising at such a speed, we need to be cautious and need to monitor very closely whether there could be cracks coming up either within the region or having a spillover from the other regions.
HKMA has a long tradition of carefully managing things like LTV ratios, for example, to prevent these kinds of financial risks building up here. And that seems to have served you well, you would say.
Yeah, the macroprudential measures that we took in the housing sector, when macro-prud, the term was not even there. We started in 1990, even before the establishment of the HKMA, with the 70% LTV ratio. And it's been providing a very good buffer for the banking system with the boom and bust of the property cycle in Hong Kong. So I think it's serving us very well.
Yeah. There's a global discussion in central banks and, of course, the politicians and ministers they answer to about the mandate of central banks. This is something that seems perpetually in flux. We've had a trend, of course, for independent central banks over the last 30 years, but some people are even questioning that banks, central banks are even able to manage inflation for all sorts of reasons. What's your view on the evolving mandate of central banks and indeed the evolving mandate of HKMA?
Well, for the HKMA, the mandate was very clear right upon our establishment. It's actually carved in the Exchange Fund Ordinance, which says our primary objective has to be monetary stability, which is to keep the exchange rate stable. We target exchange rate and not price. So it's a slightly different regime from the other central banks. And also in the ordinance, it says that once you've achieved your primary purpose, then you need to keep the stability and integrity of the financial system. So financial stability is there. And I don't think there should be any trade-off. Both have to be taken care of, probably by different toolbox. You can't use one tool for everything, but you have to develop other toolbox like macroprudential measures, the other liquidity measures to manage financial stability. And what's in Hong Kong, I think in Singapore and increasingly being considered in some other major financial centers is also, we also have another secondary objective, which is to strengthen the status of Hong Kong as an international financial center. But there's a tail to it, which says with a view to maintaining the financial stability of Hong Kong. So the two are related. So we're one of the few central banks that have a mandate for developing Hong Kong. I think the same in MAS, and it's been discussed in the UK as well. And we did that for many years. So there are different three mandates that we have, but the primary one has to be to keep the exchange rate of Hong Kong dollar stable through the US dollar pact.
Yes, yes, it is. In the UK, we, I think, slightly regret moving prudential oversight of the banks out of the Bank of England, but we'll come back to that another day. We've talked about Hong Kong as a financial centre. I mentioned that in my opening remarks. As I say, I remain very interested in the special energy that this city has, but there are other rivals, and there are various developments in digital regulation, all sorts of geopolitical issues as well. Tell me about your view of Hong Kong as an evolving financial centre.
Well, you can imagine what I would say. It's got to be good.
Yeah.
Well, the last few years was difficult in Hong Kong. You know, we've all gone through that. Social unrest, COVID, and the China-US relationship. But what really makes Hong Kong tick has not changed a bit. If you think about the financial ecosystem in Hong Kong, they're all there. You're talking about free flow of capital, common law system, good regulatory system that's aligned with international standards, talents, etc. They're all there. And what's really sort of hitting us a bit was the perception. As you said, it could be the isolation from the world. During the pandemic, that there was a bit of sort of downbeat talk about Hong Kong being a financial center. But I think the main ingredients are there. But what's important is that one unique advantage that we have is actually strengthened, which is the fact that Hong Kong remains the only gateway linking China and the world. We're very unique in that we are part of China. At the same time, we're also an integral part of the global financial system, operating on global international practice. So, with the increasing opening up of the capital accounts of China, with financial flows going into China and increasingly the flows coming out of China, Hong Kong will be the place to be. And that will be the place where, for example, for international investors going to China's capital markets, about 70% of both their stock and bond holdings actually came through the Stock Connect and Bond Connect in Hong Kong, and not directly into China. They can actually do that, but they choose to use the Hong Kong platform to launch their investments into China. In the last 1-2 years, what will be more important, in fact, starting in the last 1-2 years and going into the next few years, is what we call the southbound capital coming from China and getting into the world. That is starting with Stock Connect, and last year with Bond Connect, and we've got Wealth Connect, individual capital coming out. And most of these, if not all, will be coming through Hong Kong. So when you get all these financial flows coming through Hong Kong, the capital markets will prosper. The securities market, the bond, because there's always home buyers. When Chinese capital come in through Hong Kong into the world, they will first look at, hey, what's available here? And the capital markets will definitely grow in the next few years. But again, we cannot be just China's financial center. We need to be global. So, and that's why 4 or 5 years ago, we've been really starting making a lot of efforts in developing Hong Kong into the, to make sure that we're at the forefront of some of the global financial trends. As you said, these are digitalization of financial services and ESG. And I have to say that on both fronts, Hong Kong is squarely at the forefront with the CBDC development, virtual asset development, tokenization, the bond market flying off here, So I think we need to both develop all the Chinese opportunities and also the latest trends in global finance.
Thank you, Eddie. We'll come back to CBDCs. I think it's an important, interesting area. Mr. Yu is prepared to take a couple of questions from the audience, so I'll turn to you in a little while for questions. I've got a few more myself, but if you get ready to put your hands up if you'd like to ask Eddie a question. Just on currencies and the role of currencies. So you have your dollar peg, of course, is an important part of your role to protect that. It's also a center, of course, for offshore RMB. We've got the digital development of the yuan in China. How do you see the currency scene evolving and Hong Kong's role in these currency markets?
Well, if you look at the last 20, 30 years, the global financial system basically is a US dollar-based market. And currently, a lot of our international trade investments are done in US dollar. And I think that this will continue. But whether there will be other currencies that will come in to take a role, as you see, Euro, when they were coming out, they were starting to take a role. If you look at the reserve managers composition, Euro takes about 20%. And now with China becoming the second largest economy in the world, the largest trading nation in the world, will we see more of international trade being done in RMB? Currently, actually, if you look at the external trade of China, only about 20% of their trade is done in their own currency, which is RMB, which is very strange. If you look at all the other more developed economies, you're talking about a lot more. And also when China is already now 18% of global economy, the weight of RMB in reserve managers' portfolio is only like 2.6%. Whereas even in the IMF weighting, the SDR weighting is already 12%. So there's still a long way to go for RMB to further develop as a trade and investment currency. And for that to happen, Hong Kong will play a significant role because we are the largest offshore RMB center in the world. And we've got the largest liquidity, the largest offshore FX market, and we're developing the RMB capital markets as well. RMB bonds has been really developing well. And just last year, the RMB bond issuance in Hong Kong has doubled in 1 year. And we have just introduced the RMB equities. And I think it will take a bit of time for that to mature, but we want to make sure that Hong Kong offers the full suite of RMB products with RMB liquidity and infrastructure behind it. And China is supportive of that because for them to encourage the use of RMB for international trade investments, they need to gradually open up their capital accounts. But having a lot more RMB transactions done in an offshore center, Hong Kong, that will actually provide a firewall for them to guard against some of the shocks that might come from the internationalization of RMB. So I think that trend in the next few years definitely will continue. It will be gradual. It won't be a really sort of big bang. It will be gradual, and Hong Kong will play a very pivotal role in this process.
It's interesting, Eddie, you mentioned these themes. We'll see a little later from my colleague Clive Horwood exactly what you describe, a reserve manager's survey describing these gradual trends,
right,
which will come back, including with the euro, actually. But as you say, you would expect an $18 trillion economy to want to trade in its own currency. You would expect Hong Kong then to continue its rather unique role with as part of both of the dollar and renminbi ecosystems at the same time.
Right.
Any questions for Eddie? Please raise your hand. Please, if you could stand up and say where you're from, that would be great. Please, the lady here. Thank you.
My name is Paul Chan from Singapore.
Sorry, the man. Sorry, my apologies.
And my question concerns any symbiosis between Hong Kong and Singapore rather than to view them as rivals. Is there any initiatives? I'm sure there are some. And is there anything more you would encourage?
Thank you, Mr. Chan. That's a great question.
Well, I see financial centers around the world serving different markets and having different developments. There's always a complementary role between the different financial centers. And for Hong Kong and Singapore, we're both very small, open economy, important financial center. And we're working actually on very similar issues. Like digitalization of financial services. We're both looking at central bank digital currencies for wholesale use. So there's actually quite a lot of discussions among us about our experience. ESG, we're both developing a very new area, and we both need to develop standards. We need to develop disclosure arrangements, and some of these arrangements have to be global in order for that to be effective. So we're both on the same side of the table when it comes to international discussions about these global trends. So there are many areas that even on virtual assets, we start from a different place. Singapore has been allowing crypto in for a while. We've been very strict. Now they're getting stricter, and we are actually getting looser. So we're about at the same level. But this balance between regulation and development is very difficult to grasp. So we've been also exchanging views on that. And again, some form of global coordination has to be there because traders and transactions can go anywhere. So I think there's a lot in common that we are looking at, that we're exploring together. And we're serving, as I said, we're serving different markets. Hong Kong is very much North Asia with China almost in the pocket, because Hong Kong is almost the unique only gateway to China. But at the same time, Singapore is much nearer to Southeast Asia or India. So I think there are different markets that we could be serving. Capital markets may be stronger in Hong Kong, but commodities will be a lot stronger in Singapore. So I think there's definitely complementarities between not just these two centers, but among different financial centers. I just told John that I was in the Middle East a few weeks ago, and I was amazed at how Dubai was developing. So we've already been talking about linking up with Dubai, so that because we serve different markets, but linking up will mean that the mutual access to our respective markets by our investors will be that much easier if there should be linkage between markets and infrastructure between centers.
Thank you. I think it's a very sensible and excellent answer. Mark Burgess, Hester, I think you had a question. Please, a microphone for Mark. Here in the front row. Net to you, sir.
Thanks very much. I'm very tempted to ask you about the performance of financial markets, which have been surprisingly robust, but it'd be unfair to put you on the spot in terms of direction of markets. But one of the things that the markets do seem to be interpreting is that the financial system is robust, that in fact, I would argue that the 1998 Asian crisis, followed by the 2008 crisis, has set up a series of robust structures. You've already mentioned this, but could you just comment on that? And I know you're keeping a close eye on it, but what's your general interpretation of the robustness of the financial system, i.e. the accidents that could happen, the plumbing that could break, etc.? Yeah.
Well, this is a difficult question, because we've been looking at where the cracks could come from in the last year, because when you see QE and very easy monetary conditions for more than a decade, when people's behavior have got so used to a very easy monetary condition, even the money market that's in banks, you don't have to worry about liquidity for your clients or liquidity for the markets for almost a decade. So they actually don't have experience in dealing with tight liquidity. So when you see interest rates rising by, at that speed, you have to worry about cracks. And I have to say that I wasn't thinking about cracks first coming from the banking system, because banks are so tightly regulated after 2008-9. But again, as I said, it's not really a matter of regulation. It's more a matter of supervision. But it came from there. But what I was actually looking at a lot more is the non-bank area, because that's the area when you look at March 2020, that was an area where cracks were seen in money market funds, in the corporate bond sector, and then subsequently in CAGOs, in LDI, in commodities market. These are the initial cracks that we see. So I thought cracks will come from there. And we have an FSB steering committee on non-bank financial institutions. I'm a member of that. And we're constantly looking at where leverage can be hidden in some of these non-bank areas, whether it's hedge funds, private credit, or places where we don't see very obviously, like family offices or even pension funds, insurance companies. So we've been looking at places where there could be hidden leverage, where there could be interconnections with the broader financial system without us spotting it, like in the case of Archegos. The work is not done yet because data is not available in many of those places, and we're still collecting data. But I would say that apart from the banking system, which I still think is very tightly regulated, supervision has to be done more tightly. I will look a bit more at the non-bank sector. And also with the interest rates rising so fast, and as you can see in the US case, and especially with the tightening of the credit of many of the regional banks, and the structural changes in working from home, the offices, etc., whether there will be pressure on commercial real estate, which might spread to other parts of the financial system, whether it's through the banks or the securitization market, or more generally on the housing market. As you can see in Northern Europe, in Sweden, for example, housing prices have come down quite rapidly, and the banks are under some pressure with the high interest rates. So I think these are areas that we need to look at, not necessarily the banking system, but I'll look at more the non-bank and also the interest rate sensitive areas like real estate.
As you said earlier, Eddie, to have a 500 basis point rise in interest rates in less than a year, it's almost surprising that more hasn't gone wrong in a way. So yes, maybe that's testament, as Mark says, to some of the sensible prudential regulation. We've got time for one or two more questions. Sir, you at the back there, you had your hand up earlier.
Yeah, thanks, Eddie. Henry Lee, Hendale. I know the reserves have been managed very well and very conservatively. Thank you very much. But lately, there's been more talk about deploying that more dynamically. And I wanted to know how you intend to use the reserves. Both in alternative assets, but also locally, and what objectives you have. Maybe give us some insight into that.
Right. I think, if you look at the way that we manage the reserve, probably the HKMA is the most progressive central banking institution in the world. I don't think any other central bank has invested in private markets. We did that. We started that 12 years ago, allocating a part of the exchange fund into private markets, including private equity, private credit, and also real estate and infrastructure. And by now, we've already got about $70 billion worth of private assets, and the performance has been really good. The internal rate of return for the last 12 years was 13%, and the excess return, as you can imagine, is like 7-8%. So we've been doing that, and it's important not just for return purposes, but also for diversification, reduction of risk purposes, because through the tough year, for example, last year, real estate infrastructure has outperformed public markets. But in the good years in public markets, they might underperform. So it's also for diversification purpose as well. Hedge funds, we've been using them, but mainly for diversification purpose. We use hedge funds that has very little correlation with public market performance, so that we can again achieve the risk diversification purpose. As for investments in local markets, it's a bit difficult because we are foreign reserve managers, so we are supposed to invest overseas. Plus, because of the many roles that we have, there's always a conflict of interest. And also, just think about it. Reserve is for the purpose of meeting your contingencies. And if we invest a lot in Hong Kong dollar assets or Hong Kong assets, in case of market shocks, we'll have to sell our assets to get liquidity. And that will mean selling Hong Kong assets, and that will actually be adding salt to wound. So we can't really invest in local assets, just like other reserve managers as such. But we have actually helped the government create another pocket called the Hong Kong Investment Corporation, which has got a slice of the future fund, and they can now invest in local. In fact, they primarily will invest in assets or in investments that will not only bring returns, but also has a Hong Kong nexus, whether it's a Hong Kong company or foreign company having a base in Hong Kong or having a listing in Hong Kong. So the government will have a separate pocket for that. We're separating the roles of the two.
Thank you. My colleague Clive Hord will talk about central bank reserves in a little while. And of course, there are some balance sheet horror stories going on elsewhere. But we'll talk about
last
that
year it
another
was a
time.
bloodbath.
Yeah, exactly. So one more question for Eddie, please.
Hi, thank you very much. I'm a lawyer from Shanghai. Eddie, I think actually HKMA has done a very good job in working with PBOC, to roll out a series of initiatives to enhance the two-way connect, between China and Hong Kong and the rest of the world. For example, earlier this year, we have seen the Swap Connect rolled out, which is good news, for the bond investors internationally. So I was wondering what would be the next, whether HKMA is working on other initiatives with the Chinese regulators, to enhance Hong Kong's gateway status, linking China and the rest of the world.
Well, we have actually introduced many connects in the last year, a lot more than what we had in the last 7 or 8 years. And these are all, as you know, when you develop pilot programs with the Chinese authorities, it's always initially very baby steps. We want to make sure that it comes out in the right way, safe, risk control. So for whether it's for Wealth Management Connect or Bond Connect, especially the southbound leg or Swap Connect, there's a lot of room for those connect schemes to further deepen and expand. And that will be the next thing that we will be working on, trying to expand the current schemes. Like in Wealth Connect, the product suite is very limited. It's only bond funds. We want to expand that to, for example, equity funds. We want to see whether there's room to raise the quota. For Bond Connect, southbound, capital coming out into the bond market in Hong Kong, currently only banks can do it. We want to explore whether, for example, asset managers or even insurance companies in futures can use that channel to invest in global bond markets through Hong Kong. So there's a lot of deepening and expansion of the various connect schemes that we want to pursue. We also want to develop the full set of risk management tools, because while you get the international investors to invest in Chinese capital markets through Hong Kong, you need to give them the hedging tools. We've started that with the MSCI Asia futures, and now we've got Swap Connect taking care of the short end of the bond investments. But about 40–50% of the investors' interest is actually at 5 years and beyond. And we need more hedging instruments for that. And we're now talking to the mainland authorities on the possibility of rolling out Treasury futures, which will be another, because we want Hong Kong to be the risk management center as well for any Chinese investment. So there are a lot more areas that we're working on, a lot more to come in the next few years.
That sounds like an important development, actually. So thank you, Eddie. It's been terrific talking to you this morning. We're very grateful for your time. Congratulations on the 30th anniversary. And thanks for your graceful and helpful answers to our questions this morning.
Thank you very much, John. I hope you have a very good convention today.
Thank you. Thank you.